Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY26 earnings conference call for Moneyboxx Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. I now hand the conference over to Mr. Ankit from Stellar Investor Relations. Thank you, and over to you.
Thank you, Mike. Good afternoon, ladies and gentlemen. I welcome you to the Q3 FY26 earnings conference call of Moneyboxx Finance Limited. To discuss this quarter's business performance, we have from the management, Mr. Mayur Modi, co-founder, Mr. Deepak Agarwal, co-founder, Mr. Viral Sheth, finance controller. Before we proceed with this call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. The company also undertakes no obligation to update any forward-looking statements to reflect developments that occur after the statement is made. Documents relating to the company's financial performance, including the investor presentation, have been uploaded on the stock exchange and the company's website. Without further ado, I would like to hand over the call to the management for the opening comments, and then we will open the floor for Q&A. Thank you, and over to you, sir.
Yeah. Thank you, Ankit, and good afternoon, everyone. This is Deepak Agarwal, co-founder of Moneyboxx Finance, and I'm delighted to welcome you all to the Q3 FY26 earnings conference call of Moneyboxx Finance. Joining me on the call today are Mr. Mayur Modi, co-founder, and Mr. Viral Sheth, our finance controller. Before we dive into the details of our performance, I would like to begin by briefly touching upon the broader economic environment. India remains one of the fastest growing major economies despite global volatility arising from trade disruptions and geopolitical uncertainties. GDP growth of 8.2% in Q2 underscores the strength of domestic demand and the resilience of the core economic fundamentals. Inflation has shown sustained moderation, allowing the RBI to adopt a calibrated easing stance. In 2025 December, the RBI reduced the policy rate by another 25 basis points to 5.25%, marking a cumulative 100 basis point reduction during the fiscal year. This easing cycle, coupled with active liquidity management, is aimed at ensuring orderly transmission and stable funding conditions while maintaining financial stability. At the same time, structural reforms such as rollout of new labor codes are expected to support formalization and long-term productivity, even if there may be some near-term cost adjustments. Rural sentiment is gradually improving, industrial activity remains steady, and credit demand continues to be healthy. For institutions like ours that focus on semi-urban and rural MSMEs, this macro backdrop reinforces the structural growth opportunity ahead. Coming to our performance, Q3 FY26 reflects steady execution of a strategic pivot toward a stronger and more resilient business model. Our AUM stood at 878 crore as of December 2025, while reporting year-on-year growth is 5%. Excluding ARC transaction, our underlying AUM growth was 17%, which better reflects the momentum in the core franchise. More importantly, the composition of book continues to improve. Secured loans now constitute 60% of AUM compared to 38% a year ago. Secured portfolio is 65% of the total book. If first loss default guarantee scheme backing 5% unsecured AUM is included. We remain on track to move towards approximately 80% secured AUM by March 27. This structural transition is central to improving asset quality, reducing earning volatility, and building long-term operating leverage. Our disbursement strategy is increasingly focused on better quality borrower and higher ticket sizes. In the first 9 months of FY26, 67% of disbursements were secured compared to 44% last year. The share of customers with bureau scores above 650 has increased to 71%, and higher ticket loans above 3 lakhs now form a significantly larger portion of the portfolio. We are consciously moving towards the upper tier of the micro and enterprise segment, which enhances portfolio durability and lifetime customer value. On the financial front, total income for Q3 grew 5.6% year-on-year to 54.7 crore, Net interest margin moderated to 14% from 16.6% last year, reflecting strategic shift towards secured lending, which carries lower yields but significantly lower risk. Profit after tax grew 77.6% to 0.35 crore. Disciplined provisioning, steady collections, and normalization of credit costs will continue to improve PAT in coming quarters. Asset quality improvement has been particularly encouraging. Our own book GNPA reduced sharply to 1.43% from 5.6% a year ago, and NNPA declined to 0.72 from 2.88%. Credit costs moderated to 2.07% compared to 4.7% last year. Collection efficiency remains strong at around 94%, with improving resolution trends across all buckets. Current bucket efficiency, which is X bucket, has improved to over 99% in January, steadily growing from 98.15 in September. Every month we have seen a growth. And bucket 1 and bucket 2 resolution has improved to over 60%, which is highest since inception. These trends validate the corrective and strategic measures undertaken over the past few quarters. NPA recovery has significantly increased in recent months and is expected to improve significantly in FY27, driven by reasonable recourse. Operating expenses have remained stable sequentially, and as AUM scales across our national network, we expect operating leverage to improve progressively. Secured focus branches have already reached around 7 crore AUM at 24-month vintage, and early vintage branches provide meaningful embedded growth potential. Over the next 2 years, we are targeting operating expenses to trend below 10% to average AUM as scale builds and productivity improves. On the liability side, we have significantly strengthened our funding profile. We now work with 31 lenders, including 11 leading banks, and raised a record 302 crores through NCDs in calendar year 2025. Our average cost of funds has reduced to 12.7%. The marginal cost of funding has reduced to 11.8% for the first time. And we expect a gradual move towards single-digit borrowing costs in medium term on incremental basis as our credit profile strengthens further. Our capital adequacy ratio stands at 26.68, comfortably above regulatory requirement. Additionally, the board has approved an equity raise of 43.3 crores, which will further reinforce the balance sheet and support secured-led growth. Technology remains a key differentiator. Our proprietary Cattle AI application enables unique livestock identification, reduces fraud risk, enhances underwriting precision, and improves field productivity. It has reduced processing timelines by 20% to 30% and lowered duplication risk significantly. Combined with our digital underwriting and collection tools, this strengthens scalability without proportionate cost escalation. Differentiators such as Cattle AI, complementary Paravate services are leading to multiple global partnerships, such as Rabo Foundation, so where we got a 3.3% first loss fees guarantee as a grant, Gates Foundation, Water.org, Shell Foundation. With Shell, we have got a 10% second loss fees guarantee after 3% if we invest in green assets. Axion and more partnerships are in the pipeline. So these will lead to our unsecured portfolio having some coverage in terms of first loss or second loss fees guarantee. Overall, Q3 FY26 demonstrates that our transition towards a predominantly secured, better rated and diversified MSME portfolio is delivering tangible results. Portfolio risk metrics have improved materially, credit costs are normalizing, funding costs are trending downwards, and operating leverage is gradually building. While this remains a transition year, we believe the foundation is firmly in place for sustainable and profitable growth as AUM acceleration combines with improved efficiency and stable asset quality. Our long-term objective remains clear: to build a high-quality, predominantly secured MSME lending franchise with stable asset quality, strong governance, and sustainable return metrics, while continuing to empower underserved entrepreneurs across rural and semi-urban India. Thank you for your continued trust and support. We will now be happy to take your questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants who wish to ask a question may press star and one on your touchtone phone. Participants who wish to ask a question may press star and one on your touchtone phone. We have the first question from the line of Deepak Karwa, an individual investor. Please go ahead.
Hello. Hello.
Hi.
Yes,
I'm
Deepak.
audible, sir?
Yes, we can hear you.
Yeah.
Okay. Thank you for the opportunity, sir. So my question is regarding can you give me the slippage between first-time borrowers and the repeat borrowers?
Slippage between first-time borrower. Viral, you would have the data ready?
Yeah. Just a second. It's about 28%. If the repeat customer, they'll confirm that.
It's 28%.
Yeah.
No, it's slippages, it's the repeat and the fresh borrow.
It's in slippages or the composition of that?
Slippages.
Hello.
Yeah.
It's a 28%.
Sorry, could you repeat your question?
Can you give me the breakdown of a slippage between the first-time borrowers and the repeat borrowers?
So we can give you the NPA breakdown by that, but we don't have that readily available, that cut.
Okay. No problem, sir. Sir, my second question is regarding the AUM growth. It's remained very healthy, but profit growth has been volatile. Is there a current business model delivering an adequate risk?
Sorry. Your voice was not clear. Sorry.
Hello.
Yeah, Deepak. Sorry, please. Can you repeat your question?
I'm audible, sir, now?
Yes.
Sir, your AUM growth remained healthy, but the profit growth has been volatile. Is your current business model driving your adequate risk-adjusted return?
What did you say in the last? You said profit is volatile, and then what did you say?
Sir, your voice is breaking.
Mr. Deepak Karwa, we are asking the last part of your question. The last segment of your question, we would like that.
Okay. So my question, I repeat my question. Your AUM growth remained healthy, but profit growth has been volatile. Is the current business model delivering an adequate risk-adjusted return?
Okay. So Deepak got your point. See, there are key factors, when you analyze profitability.
Okay.
I would say that AUM growth in the first 5.5 years was very, very strong. So we were almost doubling every year.
Okay.
When we have expanded in FY24, so FY25, I would say from June 24, there has been that NFI crisis, because of which AUM growth tapered significantly, and because of which we already had that build up in terms of branches and in terms of team, which led to higher OpEx versus the AUM growth. Also, the credit flow of NPA reduced the profit. So if you analyze that, why the profit was less, is largely because of slippages and then the higher OpEx. These are the two items on the expense side, and lower growth in AUM, which affected the profitability of the company. Now, as we go forward, you would have seen in the presentation that collection efficiency is now coming back to the normal. We have already crossed 99% collection efficiency in X bucket in January, and this is now has gotten stable. In the future buckets like bucket 1 and bucket 2, resolution has gone to highest since inception. So going forward, say maybe from next quarter one, the NPA provisioning will reduce. OpEx we are working on. As the growth comes in, profit will start improving. There's still some time, but things are changing. What we have focused very significantly on the collection efficiency and going legal, which will start yielding results next year, and shifting the portfolio to that secured, better rated customer. So that transition is taking some time, but I feel that the results has now started showing up, and it's just time when the AUM also starts moving up significantly.
Okay.
And hopefully that will resolve the profit problem as well.
Okay, understood, sir. Sir, my last question is regarding branch expansion. Like we continue to branch expansion, but like our mature branches delivering the expected productivity level?
So we are not now continuing with the branch expansion, because in fact, wherever some of the branches are not delivering the expected result, we will merge those branches. There will be but however, we are now more and more focusing on the existing branch delivering better results. And yes, next year we will open some of the branches in a better geographic area, where we feel that we can really do the kind of business we want to do. So I mean, rather than very, very small towns, it would focus more on where we can, get better productivity. Like cities like Bhatinda, which gives us 1 crore every month. And, so we will try to capture areas where we can, have higher disbursements and with the larger ticket sizes.
Okay. So currently, like, is it right to say that we are not into the branch opening for a coming?
For the coming year, we will open, but largely the number may remain the same. So maybe we will consolidate some of the branches and open some branches in areas where we feel, there's a high potential for our kind of business now.
Okay. Understood, sir. Thank you so much for answering this, sir, and all the best for the next quarter.
Thank you.
Thank you, sir.
Thank you. We have the next question from the line of Nish Shah from Stellar AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. So my first question is on the disbursement side. So disbursements are moderated, though the GNPA have been on stable levels. So are we internally seeing any stress that is not visible in the reported numbers?
Is there any visible stress?
Are we seeing internally, are we seeing any stress?
No, in fact, as you see the collection efficiency, what we see, we have provision what is required, and the way we have been doing since inception, making a 50% provision on NPA. But what we are seeing mainly, Nish, is that month on month since September, all the buckets in terms of collection are showing improved performance. X, bucket 1, bucket 2, and NPA. In fact, even in NPA, recoveries have doubled, but we are yet to show them, till they take a reasonably good shape. So all across now we are seeing that bounce rates are reducing every single month. So you would notice that every month the bounce cases are reducing by 1,000 for the last 5 months continuously. X bucket efficiency, from almost a 14 crore flow in September, the January number is down to 7.8 crores. And we are hoping that in next 2 months it will be down below 6 crores. So the flow to, bucket 1 and bucket 2 will reduce. And also the recovery is, as I said, at the highest in the historical. We never had 60% plus resolution in both bucket 1 and bucket 2 in last 7 years. And so those numbers are improving, which is showing a ray of hope that market is improving, overall. Even from the disbursement perspective, our login fees, in fact, in the last 4 months, our login fees has doubled from approximately 25 lakh per month to 50 lakh per month now. But it is indicating that demand is too high. I mean, we are getting worth of 200 crores kind of logins every month. So it's not that demand is low. It's just that, off late, we have made our norms very, very tight in terms of the kind of clientele we want to onboard in the current environment. But I feel every month people are getting more and more clear in terms of what we want to source. And we are almost at the last leg of, having more people who understand this business. And, it's soon that, we will, start getting AUM increase as well. And also with new partnerships, as I said that, for example, a partnership with Shell Foundation recently, which gives us 10% second loss fees guarantee, which is kind in the form of almost like a grant, will help us build even an unsecured portfolio with a very significant guarantee program. So even that unsecured disbursement under that program for green assets will be more like a secured asset. So I think the worst we have seen in the last 18 months is now getting over, and incrementally every month we are seeing some, improvement.
Okay, sir. So just on one more thing, as you said, you implemented stricter norms for client onboarding. So what is the client rejection rate?
So okay, so almost it's like, for in the last few months we are getting a 200 crore kind of login, while the disbursements in the range of 40 crores. So in terms of what is expected, I think we are disbursing almost 20% on that. But we are seeing that, people are more and more getting better understanding of what we want to book now. So that way it's going to improve. The number is expected to improve in terms of, the lower rejection rate.
Okay. So what is the BT out rate?
BT is not much. BT is very, very minimal as of now. This is a new book. I think BT out is very less.
Okay, sir. Understood. So as we shift our books towards secure mix, our yields may tend to decline.
It's 0.4. It's around 0.4%.
0.4?
The BT out is, yeah.
Okay, understood. So just one more thing.
Including the closed loans and BT out is about 0.4. Yeah.
0.4. Okay. So one more thing, as we move our AUM towards secure mix, our yield may decline. So can you quantify the expected impact on our NIMs?
Okay. See, I can give you broadly that, first is you have to see the yield level. So because NIM is a function of multiple factors. One is obviously the spread part, but also the kind of equity you carry and kind of NPA levels you have. So our NIMs decline not just because of declining yields, but also because some part of our AUM moving towards NPA, and there's interest on those loans stop. Now coming back to the NIMs function, see the part is that we will still have some mix. So for example, our unsecured book, which will be in the range of say 20% to say, which will generate a 30% kind of yield. Maybe in future 30% of the book, which is like cattle secured loans, will generate about 25%. 30% may generate about 21% on an average, and maybe some part of say 20% may generate 18%. So I'm saying we will still generate between 23 to 24% kind of yield easily. I would say more like 24% over a medium term. But at the same time, the cost of borrowing will also decrease. So I think maintaining that NIM is not at a current level should not be very difficult, because today it reflects significant portfolio which has moved to NPA, which going forward should stop. And some of the agreements which we are getting into, as we said, that the FLDG programs, the second loss fees guarantee programs, will make us sure that there is some business which we can do also at a higher yield of around 30%, which we have been generating till now for the last 7 years.
Okay, sir.
I wanted to tell you that, that yields will, generally you would see that even with the larger players, the overall yield is around 18%, but still they are able to maintain good NIMs, good ROA and ROEs. So it's combination of multiple factors, because your cost of borrowing is also declined. So lower yield is not one single reason in terms of profitability, because to give you one point, fully secured lenders who have about 10-year book, they have a AUM decline rate of 1% every month. For us, in secured book, it is 2%. In unsecured, it is 6%. So monthly, the unsecured portfolio declines almost by 6%. So, as you shift towards secured book, your OPEX start declining and, starts compensating over a period of time for the declining yields.
Okay, sir. Got it. Understood. So how much impact positive will be on our GNPA and NNPA moving forward?
I think for the last 2 years, initially for the first 5.5 years, we had a credit cost of about 1.5%. Take it as a similar number in GNPA. This increased to 3.75%, 3.75% in FY25, and maybe close to 3% this year. From next year, we believe that GNPA will, the credit cost will decline to below 2%. And so, GNPA should not move beyond 2% going forward. Leave around maybe 1 or 2 quarters, but that's where we feel that, we will get to normalized level in the coming year.
Okay, sir. Got it. The last thing, our ROA and ROE are still below our long-term aspiration. So what specific levers are we looking at that will drive the improvement?
So this year, ROE will remain low, as is seen in the numbers, but we will start seeing improvements from next year. So I think there has been something which is staying, but current year result will be better than last, and next year, as NPA starts declining and AUM starts growing, we see better numbers on ROE and ROA. Ideally, this is the business, as I said earlier, that this is a business where you can generate ROA of 4 to 5%, not without much difficulty. So you can have it more, but if you have higher equity levels, but those kind of numbers are possible. We are still in the high yield business, I would say. So it's a good ROA is possible, except for what has happened recently. Largely due to NPA movements. Yeah.
Okay, sir. So last, how much AUM growth are you expecting for 27 and 28?
For
27 and 28, 2 years, next 2 years.
For next year, the plan is to at least cross 1,500 crores.
Okay, sir. Got it. Thank you.
Yeah.
Thank you. We have the next question from the line of Vansh Saini from Street Smart Investment. Please go ahead.
Hello. So, good afternoon, sir. Am I audible?
Yes.
Yeah. So, first of all, thanks for the opportunity, sir. I am new to the company. So, sir, could you please provide a clarity on the timeline, so by which the company accepts to fully provide for its existing bad debts?
We provide.
Hello?
So see, we have been doing the provisioning as per the required norms of RBI. So we are aligned to that number. In terms of further, I think it's a process, and our thought process is that we will be able to recover this amount. So whatever is not provided for, I mean, we require a 50% provisioning for NPA, and whatever is not provided for, we feel that the recovery will be very sharp. We have seen some cases as you go for legal recovery, and this is a very recent example. If you see one of the actors in Bollywood has to go to jail under Section 138, and I think we have been doing filings of under Section 138 very, very aggressively, and for coming year and years to come, the results will show up. As we will see that in coming year, a lot of our cases will reach. Maybe I will not be surprised if 5,000 accounts in next year reach a non-billable warrant stage. So I believe that recovery will improve significantly going forward. Maybe starting second half of FY27. Because a lot of cases have been filed, and once you have to initiate the process, and it takes some time. But we really believe, because see, our customers are there at home. We have said since inception that whatever lending we have done is not digital lending. It's a branch-led model. Every customer owns. So any customer who doesn't own a house, we don't fund. So these customers are there at their home. So once they receive pressure from the legal side, they will ultimately pay up.
Got it, sir.
So really the expectation is that over the next 3 to 4 years, we might be able to recover even the provisions which we have made. It's a statement, but there is a possibility. By next year, we will have a significant clarity on this.
Okay, got it, sir. And sir, the company is also proposing, I guess, to raise around 43 crore rupees. So could you please elaborate on this intended utilization of these funds and how this capital infusion will strengthen the business in terms of growth and profitability?
The larger part will go to book building only. I mean, see, for NBFC business, it works like you have 100 crores of net worth. You can comfortably build a book of AUM of 500 crores. So suppose this equity raise, we will have 300 crore plus in net worth, and we can grow AUM to 1,500 crore easily also through term debt, but you have co-lending VC options as well, through which you can take it to 1,800 crore as well. But I'm saying take it a reasonable target. With 300 crore of equity, you can build a 1,500 crore kind of portfolio. So that would be the main purpose of this equity raise.
Got it, sir. And sir, also considering the current market price is below the issue price of your pref. So sir, will it go on, or will it be facing any delays on this?
No, this is a recent one. This will go. Largely promoters are the contributors, so this will go through.
Okay, so are you confident of this?
Otherwise, it would not have come, in the sense that, when this raise was decided, the share price was same at current level only. So it's not something new which has come up, that price was earlier 76 and now it has declined. Even during the board meeting, the price was same.
Got it.
And the money has to come this month only.
Okay, this month, and the bank you will receive the money, correct?
Sorry?
In this month, you will receive the money, all the money from the investors, correct?
Yeah, because 12th was because it has to come within next 15 days. as per the guidelines.
In the next 15 days. Okay, sir. Okay, sir. I guess microfinance sector is the whole is standing, and all the best to you for the upcoming quarters.
Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touchtone phone. We have the next question from the line of Raj Doshi, an individual investor. Please go ahead.
Thank you for the opportunity. So my question is relating to MSME lending industry. So how do you see the industry going forward? So it was struggling for quite some time. So do you see the credit stress being peaked, or do you feel that it is still in its normalization phase?
So market,
Hello.
per se, yeah. Thank you for your question. So market has been volatile and there has been stress, and this has been the longest ever stress I would say the industry would have faced. The only thing at the say the light at the end of the tunnel, which you say, is that you would see that collection efficiency across the sector is improving. So if at the bottom of the pyramid, MFI, a lot of MFIs, and SFBs, even in their MFI portfolio, they are seeing now 99% plus collection efficiency. So that's one key thing to watch out, that collection efficiencies have improved, even in the lowest bucket. That is the same trend which we are seeing in our both secured and unsecured portfolio. So that's one, and it has been consistently improving, not like 1 month plus 1 month down. Starting second half of the year, every month we have seen the consistent increase in collection efficiency. So that's one part of the thing. Secondly, what we have noticed is that the credit demand has been there. I mean, it's not that we are not generating demand, but yes, for most of our peers as well, the disbursements have been low. Largely because everyone, because of the collection efficiency issues, everyone has moved up the curve in terms of tightening the lending criteria, in terms of the kind of property you will take, the kind of customer business you will take up. So I think situation will improve in coming months. I'm not saying that it is the same period as it was 2 years back, but incrementally, if you watch, every month is a better month. Versus last, things are improving. There's still some time, maybe 1 or 2 more quarters, but incrementally situation will improve. That's what we think.
Okay. Got it. Thank you. Also, relating to funding availability and cost of capital related to NBFC, how do you see next 1 or 2 years in that? Do you feel that the small players may face some constraint?
So it may not decline in terms of, maybe from Moneyboxx perspective, because we are still a high-cost lender, a high-cost borrower, I would say. Even at 12%, when you see the larger peers, they is at around 9%. We are still 300 on the overall basis. We're at the right cost at our rating, but then if you compare with the larger peers, there is still a large gap of 300 basis points, which we need to. So if you are asking from the industry perspective, there isn't much scope of decline in the pricing, unless foreign funding becomes cheaper because of so like last year we saw that, last 2 years we felt that we cannot raise funding through ECB sources as well, because SOFR was high, the hedging cost was high, also because of withholding tax, the cost was very high. Now, for a lender like us, there is some dip in the cost. So I think if you ask from Moneyboxx Finance, if we are able to improve our credit rating with more infusion of capital, we will still be able to bring down the cost significantly, at least 200 basis points over medium term. But if you are asking from the overall perspective, I don't believe that there is a lot left in terms of borrowing cost decreasing in short term.
Okay, that helps.
And in terms of capital raise, I think this has not. So one is that Indian market was not the flavor of the season in last 1.5 years, and particularly smaller companies and NBFC space because of whatever turmoil happened in MFI segment. It has not been very favorite. But again, now people are looking at that, things are getting better. Valuations are really, really low, which were not available 2 years back. I mean, very significantly low. So I think people who see this very, cautiously, they will realize that, every quarter things will improve and there's a better opportunity here. Because see, it's cyclical business. Every 6-7 years you see some cycle, but ultimately it's a good business to be in. So I don't see that even at Moneyboxx level, I don't feel there is a constraint to capital except that valuations have dipped. So there is more waiting to get things corrected. So otherwise, at a price, you always have capital available.
Okay, sure. And like you mentioned about the borrowings, so can you please elaborate more on our borrowing mix, like across banks, NBFCs, and capital market instruments? Like, what is our mix?
So it's close to 30. So it's close to 30, 40. I mean, the largest portion is now coming from NCDs, which is capital market. This is where you can get at a standard. So we are able to raise at 12% the secured NCDs, and the quantity is quite big. So I mean, if you want, every month we can raise 50 crore kind of funding. So capital market is playing well. About 30% will be maybe even less will be like banks and then NBFC. So banks, we have 11 banks. So every time it is due, they give a top up. I would not say they are very aggressive, but we are getting new banks onboarded. So it's overall we feel that a kind of 1/3 could be your liability mix. With banks taking the new entrant would be for next year for us would be DFIs. I believe that based on the current conversations which are going on, we would have a reasonably sized funding from DFIs and impact funds.
Okay, sure. That helps. So thank you very much. All the best for your future. Thank you.
Thank you.
Thank you. As there are no further questions, I now hand the conference over to the management for closing comments.
Yeah. I think thank you everyone. Mayur, if you want to have any closing comments.
No, I think mostly everything is covered. Yeah, thanks.
Thank you everyone.
Thank you. On behalf of Moneyboxx Finance Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.